So we saw a large squeeze to end the day on Friday, as you can see over here. We did break back above that 4,100 level. Remember, that acted as a pivot that bears wanted to stay below if they were to have more downside, because we gapped up right onto that level, and then within the first 15 minutes, we were able to reclaim back above it. That added some more bullish emphasis going forward. And then, of course, we did have to break out of this blue trend line right here, which you can see over here starts with this pivot high on May 1st, as well as connects to this FOMC date that we had over here, where this was a rejection. We consolidated right on this level for quite a bit intraday, but then eventually broke out back above it. So as of now, in terms of the short term, seems like we're en route back to this supply zone I have over here. This supply zone is between 4,170 to roughly 4,195 on SPX. This has acted as a key resistance numerous times so far. You can see all the way back here on April 18th, it acted as a hard resistance in the morning to have a sell-off from the gap up. And then also you can see over here acted as a hard resistance on both May 1st as well as over here on Friday for April 28th. So as of now, we're stuck in between this range. Every single time bears try to kind of take the reins from the bulls by getting back under this 4,100-ish level here, the bulls are able to gap it up, as we've seen both times now, and continue to the upside again. So this is acting kind of as a bear bait scenario, as I mentioned in the previous videos. And it's honestly incredible because we've been chopping in between this range for over a month now. We started all the way back here on end of March 31st to early April on this April 3rd date, and we've been chopping in between this roughly 4,050 to 4,080-ish range now for over a month. So a pretty tight range. And typically when you see this type of consolidation, especially for an extended period of time, it tends to be a form of distribution. And I've been highlighting that in previous videos, especially by looking here at the dark pool levels feature. And something that I do want to mention based on this previous week is if you look at Tuesday over here on the dark pool levels feature, you can see we had 4.5 billion in premium. I highlighted this on the Wednesday video on our channel here that we made from last week, but I do want to reiterate this in this video because 415.66 is a very key level going forward. 4.5 billion in premium is a lot of premium for signature dark pool prints. We very rarely see over 4 billion in premium, so definitely note this level, and it is above the current price even after the close that we had based on Friday's price action. We only were able to close within the 412s on SPY. So as of now, we likely will retest this level this week. That's my expectation, which would be about a retest of this gray trend line over here, which is from the 2018 high. Shared that in the last weekly prep, as well as the supply zone from up here. So do expect this to get retested. Watch and see if there's a form of a rejection. This is very likely a sell and sign of distribution, this 4.5 billion in premium. So if we're able to maintain below it, that shows a lot of that sell pressure still remaining strong, at least for the bears, and they can take it back down to take another crack at sub 4,100 to attempt to try and break it down out of this range, which again, we've been within for over a month, which is pretty crazy to think about now. But I do also want to highlight something from Warren Buffett's conference that he held this weekend. Typically, if you know Warren and just watch his content, read articles about him and stuff that he said over the years, he typically is very bullish on at least the American economy and just overall optimistic in terms of the American economy. And it's actually very rare to have him say something pessimistic about the economy as a whole. We're not talking just an individual company, but just the general American economy. And he did make a couple remarks such as the majority of our businesses will report lower earnings this year than last year. And he also said during the last 6 months or so, the incredible period for the US economy has been coming to an end. So typically that's not characteristic of something that Warren says at all. And of course, this isn't something that can be traded upon immediately. This kind of thing tends to play out over time. So it's not like the market just has to sell off just because of those remarks based on the weekend. I still expect there to be another retest up here of this supply zone going forward, especially into this week. But still, that's definitely notable, at least on a fundamental basis, that Warren Buffett is saying something like that. He did reiterate that he loves Apple and really enjoys having that as his largest holding. You can see here just based on Apple's chart, despite Warren's comments about the US economy kind of coming to an end in terms of that overall bullishness and optimism we've seen lately, Apple has just been on a tear since the lows that it made all the way back here in January of earlier this year. You can see that we did break back above this trend line here on the weekly that we've been rejected off of a few times now throughout this bear market, and it actually retested it this week, and after earnings had a large spike, was able to gap up and close the weekly candle bullish. So as of now, as long as we stay above this trend line, there cannot be any extended bearish bias because we were able to break back above it. Now, that doesn't negate the fact that we could break back below it here in the future and make this a fake breakout. That'd be an ideal ideal scenario, at least for bears and just the overall market, if you are bearish on the market like I am, to see a fake breakout and fall back under. But as of now, just based on the last 2 weeks in terms of a candle close, we're likely going to stay above here for a bit, at least until confirmation back below can be established. So continue to watch both of these trend lines. Also, just based on Apple's chart and the overall structure of the entire market, I don't really see it going that much higher here. And we do have a known supply zone around this 175 to 180 range. Very unlikely it gets above that here, especially after how much of a tear it's been on for so long right now. The rest of the market just isn't supporting a move all the way back up to these levels and getting close to all-time highs. Like if you just use a basic ruler tool here, connect where the all-time highs were and also our close on Friday, it is less than 5% of a discrepancy between our close on Friday and all-time highs, which is just incredible to even think about, especially after all the market's been through in the past year, as well as the fact that the S&P 500 is still below 4,200 and we topped out for all-time highs above 4,800. So this is a very minimal discrepancy, and overall just seems unlikely we will continue at the pace that we've seen so far throughout this entirety of the bounce for Apple, especially after earnings that we had here. So just keep that in mind. Probably going to stay range bound in between this around 165-ish level to 175 here coming up with the next couple weeks. But again, continue to watch this trend line. If there ever is a break, which is my expectation here, below this trend line to make this a form of a fake breakout, then watch out below because that will leave a lot more downside for Apple. But otherwise, Warren remains bullish on Apple's long-term view, and based on the weekly close, seems to be relatively strong so far. Now, I do want to talk about the VIX here as well. We did see a pretty substantial bounce, especially leading into FOMC and even after FOMC, as you can see here on Thursday for the VIX. It wicked all the way up above 21, which is pretty crazy because it closed the week prior around the 15s. So this is a very large bounce, but then on Friday, it just got absolutely hammered. It fell all the way down back into the 17s. Despite falling about 14.5% on Friday, we still technically closed above this yellow line here. This is the one from the 2017 pivot that I showed you guys in last week's weekly prep. So we were able to stay above, and that actually negated 2 weekly candle closes below the level, which would have confirmed a lot less volatility for the future. I remember I'd like to see 2 weekly candle confirmation signals below this level for there to be a lot less volatility again in the future. I mentioned that in the last weekly prep video. We were unable to close 2 of these below. However, also this weekly candle wasn't that bullish. Overall, we still again closed back above it, but this candle wick all the way up here to 21 shows that there's a lot of sell pressure for volatility ahead. So not necessarily the most bullish close, but also didn't confirm that more bearish emphasis for volatility because it didn't close back below this trend line here. What we did see, however, in terms of the flow was a pretty substantial $8.0 million out the money call for the 28 strike. They got the 11/15 expiration, so they do have a lot more time on this one, as well as the 1.8 million in premium for the 21 strike for the 6/21 expiration. So these are substantial prints for the VIX. We haven't been seeing as many prints for the VIX, at least from this past week. We did see them really start to have an uptick back before the week of April 24th, and we did have a spike after those prints, but we didn't have any follow through after that. So again, here we did see a spike from this past week, and these whales actually added after we did see that big down move in terms of volatility on Friday. So potentially they're looking for another spike here headed into this week in terms of volatility. But other than that, we did not see that much in terms of calls for the VIX other than these 2 on Friday for all of last week. So volatility seems fairly stagnant around this range between like 16 to 20-ish. And a lot of the spikes we've been seeing recently in terms of volatility have just been compressed and sold into for typically bearish weekly closes. So that's been the trend as of now until there's some form of a clear-cut reversal, which would have been nice if we closed a lot higher on this weekly candle, further to be some form of reversal. Until that takes place, we likely see volatility mimic what it's been doing so far and stay stagnant around this range. So continue to watch for that. Additionally, we did see the 18-day cycle play out yet again for a reversal. Just happened one day after the cycle date specifically. We had that cycle date on FOMC, and then it bottomed the following day on Thursday, followed by upside. So typically you see at least 3 days of, it would be upside in this case, because of the momentum being down into the date. You typically see at least 3 days of the opposite momentum following that reversal date. So keep that in mind going into this week. But so far, this has been very consistent overall for catching reversals. We've seen in the past, we saw downside into this date over here, followed by upside, downside into this date, followed by upside. The inverse over here, we saw upside into the date, followed by downside afterwards. So it's been very consistent consistent thus far and worked again over here. And other than that, continue to watch the levels that I provided to you in this week's video, and I will see you guys next time on Wednesday.